Hi everyone, I'm Mani, the CEO and founder of Valor. In the previous video, we discussed the basics of grantor retained annuity trusts, or GRATs, and why 99 out of the 100 richest American families utilize them to reduce their estate taxes and pass on more wealth to future generations. Here, we'll explore direct indexing and explain how it can be paired with GRATs to supercharge your returns. Let's get started. GRATs are a useful tool for minimizing estate taxes and keeping more wealth in the family over time. Direct indexing takes the well-used concept of index fund investing a step further. Index fund investing is the strategy of owning a fund that replicates the performance of a sector or a region. With direct indexing, investors buy individual securities that replicate a particular index, rather than owning a fund that tracks the whole index. Now, how can direct index GRATs outperform the traditional GRAT version? In the traditional approach, you fund a single GRAT with a number of assets, and this strategy allows you to pass on some amount onto your next generation's estate tax-free. But that approach is not optimal. The key insight is that separate GRATs, each holding a relatively volatile asset, will outperform a single GRAT holding all of those assets, even if one or more of the assets fails to beat the 75-20 rate. How does the direct indexed GRAT work? Traditionally, a grantor would place cash into a GRAT and buy a single index fund. With direct indexed GRATs, you would take the same starting cash and, instead of buying a single index fund and placing it in a single GRAT, you'd open up separate GRATs that would own each individual stock in the index. As explained in our previous video, the direct indexed version with each stock in a single GRAT will lead to around 3 times greater returns. But why? The basic rule of a GRAT is that any returns above the government's interest rate will go to your beneficiaries free of estate and gift taxes. If the trust does not outperform the government's 75-20 rate, the trust's assets will just come back to you in the form of your annual annuity distributions. In this scenario, you can simply put those assets back into the next trust and play the GRAT game again. Let's now walk through a simple example. Imagine that you set up 2 successive 2-year GRATs subject to a 5% 75-20 rate. One GRAT starts now, and the second one starts in 2 years, when the first GRAT ends with the annuities from the first GRAT rolling over to fund the second one. Scenario 1. Over the first 2 years, the trust's assets grow 5% every year and are worth around 110% of the original value at the end. The trust pays out no remainder because it didn't grow any faster than the 5% rate, so you receive the full amount back as the annuity. You then take the whole amount and place it into another GRAT in which the assets also grow 5% per year. But that trust, too, fails to outperform the 75-20 rate, so you just get your principal and interest back and nothing goes to your beneficiaries. Now consider scenario 2. Over the first 2 years, the trust's assets grow 10% annually, so by the end of this first term, they are worth around 121% of the original value. Because this trust outperformed the 75-20 rate, about 10% of the assets would go to your beneficiaries estate tax-free, and 111% would come back to you as the annuity. Now suppose that over the next 2 years, the second GRAT's assets don't grow at all. You would not have outperformed the 75-20 rate, and there would be no annuity from that second 2-year trust. Critically, in both scenarios, the assets grew about 21% over 4 years. But because the second scenario saw more volatility and more variation in growth, it outperformed the 75-20 rate and therefore left behind a reminder that passes on estate tax-free. The picture should be becoming clear. Direct indexed GRATs are a broader version of this strategy. Divide your GRATs to achieve more. Valuer's direct indexed GRAT strategy is built to maximize the GRAT's volatility, and as a result can increase returns up to 98% more, while maintaining the same risk and asset exposure as investing in an index fund. In the next video, you'll understand how you can take advantage of it. I really hope you found this video useful. If you have any questions or comments, please leave them below.
Now, a quick word about Valor. We've built a platform to give everyone access to the tax planning tools of billionaires like Facebook founder Mark Zuckerberg and others. We make it simple and seamless to pick the best strategy, set up and administer these structures at a fraction of the cost of competitors. I really hope you found this video useful. If you still have any questions, please visit our website at valur.io, where you can read more content on these subjects, play with our online calculator to discover your potential financial gains, or schedule a call with us.